Good Saturday morning to you, everybody, and welcome to Mortgage Matters with Rob Weinberg. I'm Gary Byron. Great to see you, Rob. How you been, buddy?
Good. How about yourself?
Oh, man. I could complain, but nobody likes a complainer. Nobody wants to listen to me. They listen to you, though. How was your week?
It was great.
Yeah, you look good.
Thank
Got
you.
a nice haircut. Look at
Yep,
you all
yep.
dapper here on this.
Ready to go.
On the week. You look fantastic. Well, good. I'm glad to hear that. How's business, by the way?
It's been really crazy lately, especially with all the home buyers out there.
I know, right? They're dropping interest rates and the whole nine yards. You know what? Let's talk a little, since you mentioned that, let's talk a little this morning about preparing to get a mortgage. Want to do that?
Let's do it.
All right. How long before getting a mortgage should someone, I guess, maybe start the preparation work?
I think generally you want to start the prep around 6 to 12 months before you're ready. Yeah,
Whoa.
that long ahead. And I would say even longer if you have issues with your credit or your income, down payment challenges, that sort of thing. The first question I ask someone that calls me out of the blue is, have you had challenges in the past with your credit, with your income, or your down payment?
What if you don't know?
That's the whole point of getting in touch with a lender early. We can tell you that based on a conversation, based on some questions. And now when you do that ahead of time, we've got the time to fix things. We've got the time to make adjustments. If you call me a week before or right when you're ready to buy a house, unless you have great credit, great income, and plenty of money in the bank, it might be difficult to meet those timelines. And I'm really talking here to these home buyers. First-time home buyers, second-time home buyers, maybe haven't been through the process. They don't know what's required from a credit standpoint. They don't know how much money they need, like we've talked about before. If you're someone that already owns a home and you're thinking about refinancing, you don't need as much lead time. You already own a property. So call the lender right away and let's get you ready to go. We could move forward immediately. But again, I'm more talking to people that need that long-term preparation, but a minimum of 6 to 12 months. Even if you think everything is perfect, get with a lender 6 months.
For everybody
or more.
or just a first-time home buyer?
I really think everyone. The best case scenario is we say, hey, you're ready. You can rock and roll. Let's get this done. Worst case scenario, though, and we're saying you got to work on this on your credit. Pay this credit card down. Change this. Pay this account off. And we can give you some coaching. You can't do that, again, if you're a week, a month out. This stuff takes time. It's especially relevant for self-employed people that may have income challenges. There's a lot of things that go into getting a mortgage when you're self-employed that are different from just a W-2 wage earner with a salary or hourly position. We need that extra time to make things really look the way they need to.
So what I find interesting is, all right, so it's the middle of April right now. If you are looking to buy a home next April, right now is when you should really start putting the effort in and start calling you and make an appointment and finding out where your credit score is and so on and so forth.
I have people all the time that get in touch with me and say, my lease isn't up till November. I had a gentleman call me yesterday from New York saying, I'm moving to Connecticut when my lease is up in November, got my job, everything ready to go. He's had credit challenges. He's listened to the show. He understands what's going on with that. So now we're getting him ready. And in that conversation, we actually uncovered a major hurdle. Major.
Yeah.
And he's now in his head, ready to go. I'm moving in November. I said, wait, step back a second. You just switched from being W-2 employee to self-employed. You are not getting a mortgage in November. There's no way to do that when you switch like that. So we got to recalibrate now. We have to look at your timelines and see what's realistic. Again, you're better off knowing that 6, 12, 18 months ahead of time than you are calling me in September saying, I'm moving, my lease is up, I'm moving to Connecticut, I got a job line. Well, wait a second. No, that's not going to work, and that's what he didn't realize when he called me, but that's why he did it, to understand.
He was better off keeping the job, getting the mortgage, and then going 1099
exactly,
later
and that's
on.
what we talked about, though, was that strategy of saying, okay, you're moving to Connecticut. Make sure the job that you get here is structured as a W-2 wage earner where you're going to get a set amount. That's the only way that you're going to be able to get the property in the timeline you want. Being self-employed for 6 months or even a year in almost all cases is going to disqualify you from getting a mortgage. You need to have a history of at least 2 years when it comes to self-employment. And a lot of people don't realize that. They think, oh, well, I'm going to be making more money, so that shouldn't be a problem. But it's not about what money you're making. It's how are you making that money? Can we document it? Are there expenses involved? And that's the big challenge with self-employment. When you've only been doing it a short time, we can't show the underwriter what your expenses are. Yeah, we can show you made all this money, but what about what it costs to make that money?
I get you. So, all right. So someone's thinking to themselves, all right, so my credit isn't good or I don't have enough money to buy a home. Should they still talk to a lender, though?
Absolutely, unequivocally.
Really?
This is one of those scenarios where the sooner you talk, the better. And I have a client that called me yesterday that is looking to buy a home. They knew they had credit challenges. They said, I know I need to fix it. I just don't know what to do.
Sure.
The sooner that you get, and they knew this, the sooner I speak with a lender, the better off I'm going to be because I don't have a strategy. I don't have direction. So the earlier, the better. And the better advice that we can give you. You want to plan a long-term strategy to get your credit where it needs to be. That can take 3 to 6 or even 12 months. If you've got a credit score in the 500s, it's not going to go to 600 overnight. It's going to take some time,
Sure, of course.
and it's going to take some strategy. You need to know what to do. If you don't have money saved for a down payment or you have a really small amount, a lot of people, as we've discussed, think, oh, all I need is 3%, 3.5% down. But that's not it. What about closing costs? What about escrow, prepaid expenses that we have to pay? You don't know about that as a buyer if you haven't bought a house before, or maybe you bought a house years ago. This stuff's always changing. If we can set the stage and say, hey, you're almost there. You're $2,000 away from where you need to be for the price range. If I tell you that a couple months ahead, you've got a shot. You call me 2 weeks ahead, how are you going to save that amount of money? It's going to dash your dreams. It's going to change your entire trajectory of buying a home. And in a lot of cases, it's going to put you down and out. You're not going to be feeling good about it. There's a real empowerment that comes from being prepared to buy a home.
And also nobody knows what the closing costs will be, right? Or sometimes is that often picked up by another person, like the seller, or sometimes it is. I've heard you say that.
It used to be, and it's not as common anymore.
So how much can a closing cost be?
Closing costs in Connecticut, you really want to prepare, and I heard a realtor say this on another show a couple weeks ago. They said 4 to 5% of the price of the home for closing costs. I think that might be on the higher. It is on the higher side, but here's the thing is there's 2 pieces of closing costs. There's loan costs, which are mortgage fees, underwriting fees, processing fees, attorney's costs, title insurance. Those are loan costs. But there's another part of it, which is prepaid expenses, escrow accounts for taxes and insurance. These aren't fees, but these are deposits that have to be put up front when you buy a home, especially if you're a first-time buyer or you're putting a low down payment. In almost all cases, you are required to fund what's called an escrow account for your property taxes and insurance so that the mortgage company can pay those. Well, if your taxes are due in July, as they are in most areas of Connecticut, and you're buying a house in April, how is there going to be enough money in there if you've only made a mortgage payment or 2? So the way that we get around that, the protocol, so to speak, is that we fund an escrow account so that there's enough money in there to pay both the property taxes when they're due, the home insurance when it's due, and if you're in a flood zone, the flood insurance as well would be included in that.
Wow.
That can add several percentage points. As you know, with taxes in Connecticut, they can be 2-3% of the sale of the price of the home in a lot of areas, especially the higher priced ones. So you have to have that money on top of your closing costs, on top of your down payment. And most home buyers, even if they've done this before, they forget about that. If it's been a lot of years, maybe, oh yeah, I remember I needed some money, but they don't remember how much. And everyone just touts this, hey, low down payment, 3%, 3.5%, 5%. And then people get that and they're like, I'm ready to buy a home. No, you're not. Know your numbers, get with a lender. Like you said, we're not going to know down to the penny, but we're going to be able to give you a good idea. I love overestimating on that. I've never had a client that gets mad at me that I told them they needed $12,000 and they only needed $10,000. And this is my protocol that I go through is I overestimate maybe by
Smart.
1,000 or two because there's so many unknowns. There really are. If I overestimate a little bit and then at the end of the day, you need less money, and I'm talking about 500, 1,000, a couple thousand less, they get so relieved. It's like, oh, yes, now I've got that extra couple thousand for furniture, for moving expenses. You see?
Yeah. And just listening to you